Hey everyone, welcome to this week's Stock Talk. The long holiday weekend here. We're going to do a little recap of what happened in the first half, as well as what's coming up for next week in our live stream. This is a little bit of a preview for our second half market outlook with Troy, Charles, and myself. It's going to be next week on Tuesday night at 6 p.m. Central. So I'm glad you're with me. Come join us, and we'll be hosting that on YouTube live stream. Tonight, this isn't our outlook. This is more of a movie trailer. Things we're going to cover then. We'll review what we expected coming into 2026, what happened, what our team believes investors should be watching as we enter the second half of this year. The good news, our primary outlook for 2026, it remains intact. The bad news, if our outlook remains correct, the ride may get a little bumpier once again before the cycle is over. Our title for 2026 back in December was, in some years, bull riding is harder. And year to date, 2026 has certainly been one of those years. So, first part of this episode, let's look back and how did the first half of 2026 do? How did that play out? Investors, let's start with the scoreboard. The S&P 500 is up roughly 10% year to date. Sounds very easy. It wasn't. During the first quarter, investors endured a 6-week and roughly minus 10% correction tied to the Iran conflict. Since that low, the S&P 500 has rallied more than 20%. We warned investors about market volatility in our original 2026 outlook. Not a bear market, not a recession, but a bull market with more volatility. A bull that tries to buck investors off its back. That's what we got in the first half of the year. But in reality, this kind of move lower isn't unusual. Let's revisit Charlie Bielow's data on market downturns and their frequency. Look at the chart. One of the biggest mistakes investors can make is assuming volatility means something is broken. History says otherwise. Average frequencies of market declines, these occur in even and secular bull markets. Minus 5% decline happens almost every year. Minus 10% decline happens roughly over 18 months. And a minus 20% bear market occurs about once every 4 years. Volatility is normal. It's not enjoyable for most, but normal. It's the admission price for long-term stock market returns and trying to compound your savings above the inflation rate. So what did we get right in the first half? Back in December, our team highlighted 3 major tailwinds. The first tailwind was earnings. As of the year-end 2025 FactSet expected strong earnings growth for 2026. Since then, those earnings estimates have gone even higher. Fourth quarter 2026 earnings expectations have risen from roughly $82.50 a share to more than $90 a share. That's over a 10% increase in just 6 months. Second factor we looked at, economic resilience. Despite war headlines and inflation fears, the overall consumer held up better than expected. Tax refunds helped offset higher energy costs, AI spending remained exceptionally strong, and economic growth accelerated in the second quarter off a first quarter slowdown. Third, interest rates. While rates remained higher than the last 5 years, they have stayed contained below 5%, allowing earnings growth to remain the primary driver of stock prices. Not PE expansion, not there in 2026, just earnings growth. Those 3 tailwinds largely explain why the market continues to make new highs. So what are we looking for the second half of 2026? Let's talk about why you're watching and why you should tune in next Tuesday. So what's next? Our team's outlook boils down to 3 major tailwinds and 3 major headwinds. First, the good news. Let's look at the tailwinds. First, that's earnings are still accelerating. Earnings accelerating remains the most important chart in the market. Corporate earnings. FactSet currently projects second quarter earnings growth of 22%, third quarter 25%, and fourth quarter 23%. The full year 2026 earnings are expected to grow more than 23%. Then, 2027 earnings are projected to rise another 16%. Those aren't recession numbers, those are expansion numbers. Remember, over long periods of time, stocks follow earnings, not politics, not headlines, not social media. They follow earnings. Second tailwind, interests remain relatively contained. Financial market inflation concerns peaked at the end of the first quarter. Here's the 2-year break-even inflation rate the last 10 years. Overall, the 10-year Treasury has moved higher in yield, but it's not enough to derail earnings growth. At roughly 4.4%, a rate that's about 50 basis points higher year to date, but that's manageable. Using a simple valuation framework, today's earnings estimates still support current market levels. Despite many doomer predictions of market collapses, stocks are not wildly disconnected from earnings fundamental. The third tailwind. What are we looking at? Falling energy prices. That's the third tailwind. Energy prices have collapsed from their first quarter spike. That acts like a tax cut from consumers for the rest of the summer. That's good news. Lower gasoline prices mean more money available for spending elsewhere. Historically, that supports both consumer spending and corporate earnings. So, what are the headwinds for the second half of this year? Well, first one, peak growth may be approaching. What do I mean by peak growth? Here's the quarterly FactSet earnings progression. This is the biggest risk investors are missing. Not earnings. It's the growth rate of earnings. Notice the difference. We believe peak earnings growth will likely occur in the third quarter of 2026. After that, earnings may continue rising, but at a slower pace. Markets often struggle when growth accelerates less rapidly than before. Deceleration can be difficult for investors to digest. Sometimes great isn't good enough. For the second quarter, S&P 500 earnings are expected to report year-over-year growth of 21.9%, with revenues up 12%. In the third quarter, projections 25.3% in growth and revenue, 10.7%, and in the fourth quarter, a slowdown, even though earnings growth is 22.8%. For the whole year, earnings growth 23% and revenue growth near 11%. Then slightly slower next year at 16%. In earnings growth and revenue growth of 7.6%. Okay, the second headwind. History shows markets often test a new Federal Reserve chairman. Alan Greenspan, Paul Volcker, Jerome Powell, each experienced meaningful market volatility during their first year. Investors should pay close attention to inflation expectations, policy decisions later during the summer of 2026. The third headwind, the dot-com analog. Many of our viewers know we've been comparing today's AI investment cycle to the late 1990s technology cycle for almost 15 months now. Our thoughts? If it is a bubble, it was early in the spending cycle, and we wanted to be invested in all its beneficiaries. So that comparison remains surprisingly close. If that historical roadmap continues, we may be currently entering the early ninth inning. That doesn't mean the game is over. It does mean investors should recognize that late cycle opportunities often come with late cycle volatility. So what's our working thesis? Well, we had to summarize our outlook for the second half of this year. In one sentence, it would be this: strong third quarter, more difficult fourth quarter. In fact, we would not be surprised if the second half becomes a mirror image of the first half of this year. Strong markets into late summer, new highs, and increased volatility as growth rates begin slowing. Investors focus on 2027. So what does all this mean for investors? For now, it means the bull market remains alive. Earnings remain strong, interest rates remain manageable, and AI-driven capital spending continues to support overall economic growth. Investors, it also means you should expect volatility. The later stages of bull market are often the most profitable and often the most emotional. That's exactly what we'll be discussing next Tuesday. So please join us live next Tuesday, June 23rd, at 6 p.m. Central on YouTube. Join Troy, Charles, and myself. We'll cover the complete second half market outlook, stocks, bonds, energy, interest rates, AI, earnings and valuation, portfolio positioning ideas. We'll also have some live Q&A. If you enjoy this content, subscribe to the channel and join us Tuesday night. Because in some years, bull riding is harder, and in 2026, may be still a few surprises left. I'm Perras, and thank you for watching. We'll see you Tuesday night.